Jesse Felder, thanks so much for coming on Wall Street Unplugged.
Hey, Frank, I'm thankful for the invitation. Glad to be here.
So you've been at this for a long time, enough to either study or maybe remember. I don't know how old you are. I won't ask you how old you are, but the 70s, the 80s type of inflation. And, we never really had crazy inflation. We could say some certain period since then, but I think people do not understand what runaway inflation is and how there's nothing you could do other than take money out of the system. You've been talking a lot about inflation as a big concern for you. Why is it different this time, and what could happen to the markets? And what has you worried here? Because it sounds like from everything I read, you cite tons of stats on your blog about inflation going crazy right now. But what has you worried the most?
Well, yeah, I do think it's not so much trying to worry people. I think it's just to be aware, and the Fed has been very, very communicative, very open about what they intend to do. Jay Powell, to me, that I think the simplest way to explain it is this inflation rethink is essentially the opposite, the mirror image of the Volcker Fed. Obviously, Paul Volcker, reined in runaway inflation in the early 80s by essentially breaking the back of inflation. But the way he did that was by changing inflation expectations and basically convincing the markets, convincing consumers that he was going to do whatever it takes to rein in inflation. And so, since that time in the last 40 years, we've had a disinflationary environment. And, part of that is inflation expectations. There are other things, I think, demographics and globalization that have played a big role too. But now we have a Fed that's basically doing the opposite of what Paul Volcker did, which is said, we're going to do everything in our power to create inflation, allow inflation to run hot. And at the same time, we're seeing fiscal policy step in with a very similar, mandate. And I think that's, what is the main difference between what we saw kind of during the financial crisis and in the early years coming out of the financial crisis, which it was all just monetary policy back then. And quantitative easing didn't result in inflation because fiscal policy, we saw the Tea Party, take, a lot of control in Congress. And there was a lot of, fiscal, not austerity in the way that we saw in some places in Europe, but relative to what we're seeing today, there was serious austerity on the fiscal side. So today we see a Fed that wants to create inflation through monetary policy and fiscal policy, spending trillions and trillions of dollars in ways that we haven't seen in generations. And so I think together, you have to take, there's the famous adage, don't fight the Fed. Well, the Fed is right now saying we're going to create inflation. We're going to allow inflation to run hot. And I think investors should, if you believe don't fight the Fed, you need to protect yourself against these inflationary impulses.
Yeah, we'll go over how to protect yourself. I think that's a great segue. But first, when you talk about Volcker, he also raised rates incredibly, right? I mean, the prime rate was 20% back then. It resulted in 2 recessions, right? And just a massive slowdown. So it's almost like you're taking the leverage out of the system, right? So you mentioned a lot of good points with the Fed saying we want inflation, but does the Fed actually know how much inflation is actually out there? Because not that anyone's smarter than the Fed, I'm not saying that, but when I look at the CPI, your goal was 2%. On a compound annual growth rate based on the last number, it's over 4%. Core import prices, same thing. CAGR is over 8%. We're seeing businesses around me in Florida and my podcast, just like your podcast, we'll talk about that later, amazing podcast that you have. I get tons of emails from all over the country, all over the world. And just especially the US, not just in Florida, businesses are open at 60%, 70%, not because they're not allowed to be open 100%, because they can't find employees. And you're seeing, you're seeing wages starting to rise, right? It's going to result in much, much higher prices. You got to pay these people even more money. To me, for me, it seems like the Fed should be like, okay, we're achieving that, but it's still pedal to the metal, right? Buying bonds, QE, trillions more coming into the market after $10.5 trillion already injected into this market. And the Fed just Powell came out and said, hey, we're going to have low interest rates through this year, maybe through next year. I mean, could we see like a double-digit inflation rate? Because once it starts going, it's like a train going downhill. It seems like it can't be stopped. And right now, it just seems like the time, like, hey, everything's pretty much working. Everything's all-time highs, other than, the market's sell off a little bit today. That's kind of what has me nervous, but I don't know. And I'm using that word nervous or cautious where I'm positioning myself for inflation. But I don't know if do you think the Fed's behind the curve here?
Yeah, I absolutely do think they're pretty far behind the curve, and that's by design. I mean, that is exactly what they're trying to do with this inflation rethink. That they, it was probably 2018, 19. They did their listening tour, I think they called it, where they wanted to hear from consumers and businesses and people who were maybe unhappy with the way Fed policy had worked in previous years. And I think the conclusion that they came to and that they've told us is that in trying to get ahead of inflation and be too, hawkish, they've potentially prevented a lot of people from maybe earning as much money as they should be earning, and really seeing the full employment that they'd like to see. So, this allowing the economy to run hot, allowing inflation to run above 2%, is all supposedly in an effort to get a lot of the low wage people who have wanted a job, maybe haven't been able to get one over the past cycle, to really push the limits of what full employment looks like, and then I push wage inflation. So I think Joe Biden has talked about, and I think Jay Powell is on the same page here, is that this inequality, wealth inequality, income inequality, these are challenges that I think Joe Biden sees as his primary mandate, is he wants to be the most labor-friendly president in history. He said that. And I think Jay Powell looked at it as his job to enable that, encourage that in any way he can. And so allowing inflation to run hot is, his way of saying, okay, we are going to help try and push wages up. We are going to try and get more of these people on the kind of lower rungs of the workforce, the opportunity to work and to earn more money than they've maybe been able to earn. Like you said, the risk to that is allowing inflation to run hot and inflation expectations to really run away. And I think that's the danger that the Fed is playing with here, that if you allow inflation expectations to start really running away and people, you look at the real estate market. I think the real estate market is probably a good example of what we might see in the real economy. So you have people paying incredible prices for real estate. Prices are up 20% year over year in a lot of places, like they are here in Bend, Oregon. And, people aren't shy from, bidding, well above asking price and these types of things, because they believe, if I don't get into the real estate market today, I may never be able to buy a house in the future. Now, that's the mindset that creates these runaway prices. And if you see that mindset shift to things in the real economy, like, groceries and gas and, lumber and all these things, we're seeing, prices already take off. But if that inflationary mindset shifts to, what, I need to fill up my gas tank today because gas prices are going to be higher next week. They've already, the energy companies have already said we could have gas shortages. We could have gas stations run out of gas this summer. Kind of a throwback to the 70s. And so that inflationary mindset can become very problematic for the Fed.
And you cite a bunch of reasons on again, you can follow Jesse Felder through his website. We're going to get to that in a little bit in his podcast, and which is really, really cool, and his blog. But you're talking about some of the effects of this, where it sounds like you're expecting, peak earnings per share growth. You're looking at margin contraction, right? Where we're in the growth market and expectations are high for these companies to continue to grow. We all saw the FANG names. I know you cover them as well. Those earnings were absolutely insane, 30% above the estimates. And also you cited insider selling too, which you're seeing, and you provide a great chart on your site, just showing how, during these periods when you see excessive insider selling, it's usually just, that pre-warning that the market comes down. So I guess, how do you position yourself if you're seeing this type of environment? Because when you have inflation, the early stages of inflation, if you want to say this is the early stages of inflation, you see a lot of asset prices rise tremendously, and they could go, as much further, than anyone ever believes, and same on the downside. So how do you position yourself? I mean, you're looking at gold. Is it Bitcoin? Is it cyclicals or, tips? I mean, how do you position yourself to protect yourself? And what are you telling, your subscribers?
Well, yeah, I think, to first look at the equity market, I think a lot of people don't appreciate the fact that if you're trying to fix these problems with wealth and income inequality, what that means, another way of saying, I'm pro labor, means and this Joe Biden will never say this, and Jay Powell would never say this, but pro labor means you're anti capital. I'm not saying like anti-capitalism, but the main thing I look at is corporate profit margins. And if you look at the last couple of decades, the last 10, 15 years specifically, we see corporate profit margins are higher than they've ever been in history, and that is the direct inverse of labor share of income. So labor share has gone to the lowest levels in history. So how do you promote labor? How does labor make more money? How do you fix this income inequality? Well, labor takes share back from capital. What does that mean? That means corporate profit margins come down, and we're seeing the Biden administration say we want to raise corporate taxes. We want to create 1 million new jobs through this infrastructure package. We want inflation and the economy to run hot. All of these things are pointing to lower corporate profit margins. And if you lower corporate profit margins, valuations today are already off the charts. Equities have never been more expensive than they are today. In fact, I just put out a piece to my subscribers that shows, based on the Warren Buffett yardstick, which kind of takes margins out of the equation and shows that I think the true valuation of the equity market. We're about 40% more expensive than we were at the peak of the dot-com mania today, which means stocks would have to fall 30% today just to get back to the peak valuation they saw 20 years ago. So there is a lot of potential risk in the equity market. Returns over the next 10 years, 20 years could be very, very meager relative to what we've seen over the last 10, 20 years. I do think the only actual investment case that can be made for anything in the markets today is things focused in real assets, things that are outside the purview of the manias in equities, in ESG, in think of all the popular strategies today, cryptocurrencies. To me, I think where I'm seeing real value in the markets today and a real compelling investment case is in the energy sector, which I've been pounding the table bullish on for the past 6 months, and in the precious metals. I do think gold is probably the most tried and true way to protect yourself from currency debasement and inflation, historically. And ironically, today, with the fundamental case for gold improving so much, I think, over the last few months, it's ironic to see so much money flow out of gold ETFs and sentiment towards the precious metals generally become very, very depressed. I think it creates a very interesting opportunity.
Now, in all fairness, because I hear the same argument with .com, and I agree with you, stocks are expensive, but is it a fair comparison? Because I remember the .com era, and it was just, you saw so many companies that don't have earnings. Today, you have Facebook reporting $55 billion in sales, hundreds of billions of dollars on the balance sheets of these companies. They're just so much bigger, where even, they're trading at 23, 24 times earnings based on those crazy earnings that they just reported, which I don't know if it could be repeated going forward. Some of them, when you look at Facebook and other things, and also, Google, Alphabet. So is it an apples to apples comparison? Because I remember back then where, to me, it seems like crypto is more like the .com era, where these things just, nobody even knows what they do. I mean, you only had a couple of web pages then. These guys had billion-dollar valuations. But you're looking at some of these big technology companies and the profits that they're generating. I could see margins contracting, but is it going to be like a .com thing where, that was a massive, people don't remember that sell-off, right? I mean, we have sell-offs now, they happen within like a few weeks. And even we look at COVID, the last sell-off, a big sell, 30% plus in S&P 500 took place pretty much over a month, maybe 40 days. When the tech market blew up, I mean, that was a 3-year, painful 75% decline. So, do you think that we could see that, or is it more like these things really need to correct to where we have valuations that are more in line with the potential growth, which we're not going to see this exceptional growth, right? This is after COVID and stuff. So I was just curious on your thoughts on that.
Yeah, obviously it's not apples to apples comparison. There's always, history rhymes; it doesn't repeat. But I do think there are a lot of parallels. I think, if you actually, we're trading through that period in 2000, 2001, 2002. Value investors had a wonderful time through that period. There were tons of stocks that were actually really, really cheap in 2000. These were typically the kind of the bricks and mortar old economy stocks, if you will, that were kind of left for dead when technology was taking off through 98, 99. And so you look at the Russell 2000, and it actually was flat or even gained from 2000 to 2003. And that was because Russell represented a lot of those kind of more value kinds of stocks. I don't think it does today. Today, I think, when you look at the median stock in the S&P 500, it is 50% more expensive than the median stock was back in 2000. So I think back then it was really a tech focused bubble. There were a lot of blue chips that got really expensive too back then, but it wasn't. I think the bubble in equities is much broader today. We see it. My friend John Hussman has done some terrific work on this, where he shows the cheapest decile, the cheapest 10% of stocks in the market today are significantly more expensive than they were in 2000. And so the breadth of the overvaluation in the market today is more significant. It's much harder to find value. Yes, those stocks, Google, Apple, Facebook are probably not the best examples of the overvaluation in the market today. I think probably the best examples are going to be a lot of the EV names, a lot of the SPAC focused stuff. There's just a lot of stocks. I think, to me, things that I've been shorting over the past few months are a lot of these stay-at-home stocks got incredibly overvalued. Peloton, Zoom. Not only were the stocks popular with kind of the stay-at-home traders, but they really benefited from some kind of one-time unique boosts to their top line that very similar to the dot-com bubble. A lot of people forget one of the drivers of the dot-com bubble was this Y2K potential disaster that people thought a lot of computers were just going to crash when the calendars rolled over from 1999 to 2000. And so there was a huge boom in spending on computers and software and all this kind of stuff leading into that. And it also left a huge hangover after the calendar rolled over to 2000. There weren't any problems. And people had, a bunch of demand had been pulled forward from the future. There was kind of you saw a lot of these companies that were, great companies, have kind of a real hangover in that was represented in their numbers. And I think we're seeing that in a lot of these stay-at-home stocks. And they still are, terrifically overvalued, most of them. And, we could probably see that too in even a lot of these, popular names. You look at Apple, had a huge quarter. Because, selling 5G phones and, people are excited to get back out and shop. And I think we're probably seeing that in Facebook and Google's numbers too, where a lot of companies are like, okay, we really need to get ahead of this boom in the economy through advertising. And those are probably one-time gains. Amazon is probably another good example too. I don't think it's a coincidence that Jeff Bezos is retiring today and potentially wanting to go out on top. Amazon is clearly one of the beneficiaries of a lot of this stay-at-home stuff. And you mentioned my insider selling metric. Jeff Bezos has been selling, massive amount of stock over the past 6-9 months. And the numbers generally suggest that insider selling has been off the charts. We see massive inflows into equities on the part of retail investors. And conversely, we're seeing insider selling. And, the IPOs are, very similar to that, the Coinbase IPO, where a lot of these, investors want to cash out of these things. The smart money is cashing out while retail money is clamoring to get in. That's typically, a late cycle sign.
And you break a lot of these things down, in the Felder Report and your blog and your podcast, stuff like that. But you also bring in the point where you see, a boom in fraud, and that usually happens closer to market tops, right? And you bring up some great things like the price manipulation, where you're seeing, look at Dogecoin, right? I mean, it's incredible. GameStop, and you mentioned SPACs, right? Where it's just, I won't get into SPACs, but it's just great how they're structured. And now the SEC is finally saying, okay, we have to count for warrants a certain way, but it's just like a get rich quick scheme. And, as long as a retail investor is buying it, it's going to work. And now the retail investor is not really buying it. So they're probably going to go away like they did in 2017. But you also talk about the ESG policies, where some of these policies, companies are just announcing that they have these policies or announcing that they have Bitcoin on the balance sheet. And that kind of manipulation. So, you do provide a lot of evidence, right? I looked at your research, and you're not a perma bear or anything, but just there's a lot of things that are coming together that suggest your thesis could be right.
Well, the fraud thing is important. I think it was Manias, Panics, and Crashes. I pulled a quote from that book where they, I think it's Charles Kindleberger, points out that very late in manias and bubbles, you start to see, a lot of fraud revealed. And a lot of times that, fraud can be, precipitate a stock market crash because it changes risk appetites. People, we were talking about 2001 and 2002, and WorldCom and Enron were two massive frauds revealed when the bubble was bursting in the wake of the dot-com mania. I'm just seeing so many frauds revealed today that it absolutely suggests we're late cycle. Whether it's Greensill or Wirecard fraud, in Europe, but we're seeing plenty of them here in the United States too, and to me, I'm going to bungle the quote, but Kindleberger says that's a sign that potentially liquidity can be waning, and a lot of these fraudsters see the window closing and their opportunity to cash out or take the money and run. And so a lot of these things are the result of that feeling like, okay, now is my opportunity to cash out, and if I don't take the money and run, then I'll never have the chance to do so. The cryptocurrency frauds in Turkey that we've seen, billions of dollars essentially embezzled. There was another, I can't remember, there's another example in the post that I put up, but a central banker who had stole $300 million or something like that from the central bank. It's just it's worldwide, and it's just becoming so rampant that to me it's like this is a sign people need to be more skeptical than usual. Really need to start taking a defensive posture.
Now let's talk about your newsletter, the Felder Report. You have a background. You worked at Bear Stearns. You also co-founded a multi-billion-dollar hedge fund. What made you switch to becoming a publisher, to becoming, more of a newsletter writer? Because that's a big transition. I've done both as well. But I really like it. We're helping an individual investor, having the freedom, right? My freedom, where you're not under anyone's umbrella or anything, where you kind of have to support their agenda sometimes. But let's get into that because it's pretty exciting stuff, and you've been doing this for a long time.
Yeah, I think what really precipitated for me is my passion for the business is really on the research side of things. I just love looking for investment opportunities, analyzing investment opportunities, and so the other side of that too is the research business, the newsletter business allows me the freedom to focus on that. But also, I do have, I started the blog back in 2005, and that was kind of precipitated by, the real estate bubble. And I had gone through, I was a head trader of a hedge fund, through the dot-com mania, watched that. I kind of had a front row seat, watched people make terrific fortunes and lose everything in the bust. And during the real estate bubble, I kind of felt the same way, that this is deja vu, and it's only 5 years later. So I kind of started the blog in a way to say, hey, I think if I can help kind of spread the word here at all, and maybe save people some money, then that's worth it to me. And so the newsletter allows me to, I guess, help educate people, help share my passion. with people. It's a price point where hopefully anybody can be able to afford it. And that's vastly different from running a hedge fund where you have to have, qualified investors. And I really do, I think, much prefer, teaching a man to fish rather than giving people fish. And I think the newsletter business is much more suited to that.
No, it's great stuff. It's the FelderReport.com, guys. Hit the subscribe button if you want, and really great stuff. You have a blog. Another thing I want to go over here is the podcast. It's nice to see, Art of Worldly Wisdom is the name of your podcast. And you've been doing, I believe, since 2017. I've been doing this for 14 years and nobody knew there was a podcast was back in the street.com days when I was working with Kramer on Wall Street. But it's nice to see so many people getting into it, and you've got into it pretty early now. Everybody has a podcast now, but talk about the podcast. You're interviewing some great people here. What made you launch a podcast? Because I get that question a lot. I'm sure you do too, where people want to have that voice, but also for me, interviewing guys like you and interviewing people for 14 years every single week, the benefit is mine just as it is for everybody listening to this, right? It's incredible with the context and the network that you build up, but what made you do it? And I'm glad you're doing it, and it's great to see you doing a podcast.
Well, I put out a lot of free content that, in addition to the blog, I put, have a Saturday morning email that goes out, and I started the podcast kind of in the same vein where I look at those platforms as an opportunity to really highlight the work of people who I think are doing, fascinating work. And so, the podcast was an outgrowth of that. That Saturday morning email, I try and put out, research pieces or charts or just highlight other people's work that I think is really valuable to me. And the podcast was kind of an outgrowth of that. I said, there are people that I really admire in this industry who I think are doing terrific work and maybe don't have, the exposure that I feel like they should have. And so I see the podcast as my, selfish opportunity to really pick their brains for an hour or however long we spend. And then also to kind of, just highlight and share the work they're doing with my audience. And so, it's given me the opportunity to interview, Roger McNamee, one of the first investors in Facebook, and multi-billionaire who's now kind of turned, tech, I don't want to say anti-tech, but anti-surveillance economy, and talk to, somebody like Diego Perilla, who, I spoke to about, not just the bubbles in the markets today, but how to take advantage of the anti-bubbles. What are the opportunities that are created by these bubbles for investors who are looking for them? And, and so it's just been a lot of fun for me to do the podcast. I'm really not very good at it, but it's been a blessing to me to be able to talk to a lot of these people who I just, really admire.
Yeah, no, actually, it's really good. So, Art of Worldly Wisdom, I appreciate the modesty. Now, last thing here, we're coming to the end of it. So, if someone subscribes to your newsletter, which this is one of the things I love talking about to my guests about, especially analysts. What is your methodology? It sounds like it might be top down, because we've been talking about the economy, inflation, how to position yourself. Is it bottom up, where you look at individual companies and earnings growth potential, or I don't know, so technical, value based, fundamental? This way, people know, hey, what they're going to get when they subscribe to your product and some of those ideas.
It's a good question. I really consider myself, a jack of all trades, master of none. I really started out as a fundamental kind of value investor, but over the past 15, 20 years, I've incorporated some other disciplines. So, really the core of what I do, and this is really kind of more for the pro subscription, is I'm looking for opportunities. A lot of that comes from studying insider buying and selling. And so, I'm looking for a stock that's cheap, maybe has, a significant amount of insider buying that kind of validates my idea that it's cheap and not cheap for a good reason, but undeservedly so. And, I do use a lot of technical analysis and sentiment work to kind of improve my timing. I met Tom DeMark about 15, 16 years ago and have been studying momentum really since then. I had, Michael Oliver on my podcast, who founded Momentum Structural Analysis, and he does some fascinating work in that space too. So I do think as a value investor, it can be really critical to be able to add this kind of a momentum analysis, looking for signs of exhaustion and downtrends, and traditional stuff that swing traders might use, but using it on a longer term kind of investment basis. And I think that's really helpful. I mean, it was one of the things that really turned me bullish on, the gold price in 2015, 16, and, turned me super bullish, like I said, on energy last year. The valuations got incredibly cheap. At the same time, we saw massive insider buying in stocks like Continental Resources and, so a lot of the energy infrastructure stocks. Mm-hmm. And so, I look for a margin of safety, but I also want a lot of these signs of like momentum and insiders to kind of confirm my ideas.
That definitely makes sense. And speaking of ideas, which my audience always loves, and I'm sure your audience always loves from your guests, do you have any individual ideas? And if you can't share them, I don't want to share anything that people are paying for in the newsletter, but I know you said you like gold, different sectors, inflationary sectors that we talked about earlier. Is there any individual names that you'd like to share?
There are several that I still own. I think right now I'm probably more focused on the short side, and then on the long side, I do think we're kind of potentially at another turning point in the major trends. I think, like you mentioned, we're seeing SPACs fall off. A lot of these things that have been the real focus of risk on, risk appetites have reversed and rolled over. A lot of these SPACs are down 40%, 50%. I think we're seeing a lot of, to me, that's a sign of, breadth divergence in the market and potentially shifting risk appetite. And so, I've been focused on, like I said, shorting a lot of these stay-at-home stocks. I think, the ARC Innovation Fund is pretty vulnerable right now. And small caps, I think small caps have gotten extremely overextended, overvalued, and they're basically a huge play on this reflation trade. When the one of the signs I look at to kind of analyze that trade is the reflation trade. Is you look at the relative performance of cyclical stocks. And that peaked back in February and is potentially rolling over right now, which is not a great sign for risk, that risk on trade, that reflation trade. And I think small caps might be one of the more vulnerable areas.
Definitely makes sense. So, I agree with you. I mean, those short opportunities look very, very good. And even though outside of today, when the markets are coming down pretty sharply, the markets are very deceiving, trading all-time highs, but you see in the ESG names, a lot of these SPACs starting to get nailed now pretty hard. So it is interesting. So this is the last question I'm going to ask you. I hope the answer is yes. Even if it's not, if I were you, I'd lie about it and say yes. But I see the guitars in the background. You have any relation to Don Felder? And I don't know if you got that question before, and somebody wanted me to ask you that, and I said, I can't find anything, but now you get the guitars in the back. I'm hoping the answer is yes.
Yes, Don is my dad, and I have a guitar hobby, and it's probably pretty obvious where it comes from.
That's great, guys. Just in case you don't know what you should know, lead guitarist for the Eagles for a very, very long time. So that is all. We could have talked about the whole podcast just about that. So I'm glad I waited to the end. So this way we're kind of out of time, but. Just thanks so much for coming on. I appreciate it. I love the work that you do, and I really got a chance in the past, 4 or 5 days to really go through everything which I do. I like vetting, this way I'm fully prepared for interviews, and just seeing a lot of stuff that you've been writing about. Just really cool, and also the people that you follow. If someone wants to follow you, how could they do that? And also, if you want to give your Twitter handle as well, because I know people love to follow people on Twitter.
Yeah, I do. I'm fairly active on Twitter. I do a lot of reading and things, and I usually tweet out some, probably way too much, but it's a lot of the stuff that I'm reading, I'm finding valuable. It's just at Jesse Felder, and then, the blog and the newsletters at thefelderreport.com.
Yeah, and again, being modest, because I was 120,000 or over 100,000 followers. So, you're doing something right. We have that many followers, which is really cool. So, thank you so much for coming on. And if you ever need anything, feel free to give me a shout. I'd love to talk research and talk stocks and talk ideas with you, but I really appreciate coming on. It means a lot.
Yeah, it was a lot of fun, Frank. Thanks for having me on.
All right, take care.